As 2009 comes to a close, I'm going to discuss what to expect in the mortgage market for 2010. Many of you are asking questions, will it be worse or will it be better than what we've already experienced going through the worst global credit crisis in human history? 2010 will be a great year for borrowers. It is hard to believe given that we are recovering from a global credit crisis. However, there are new lenders coming into the industry, which means that there is a new supply of products available with solutions that will help the mortgage consumer as they look to borrow money for their real estate assets. Rate-wise, we also expect to see stability and normalization of some of the interest rates, although towards the end of 2010, we will see either the variable rates and the fixed rates or both going up. Historically, we are still enjoying some of the lowest interest rates, either variable or fixed, that we have ever seen as Canadian consumers. Many of you who will be renewing your mortgages in 2010 will actually enjoy the benefit of saving money because your payments will go down on a per month basis due to the reduced interest rate that you'll be paying into the new year. For those of you who borrowed money in previous years, 2009 and 2008, you did experience real problems with lenders shutting their doors and having borrowers sitting at the lawyer's office with lenders who couldn't deliver the funds when they needed to close a real estate transaction. Rest assured, the end is near. There are new lenders propping up every day, introducing new products and new solutions for clients that we have not seen before. So this is an exciting 2010 as we embark on this great new journey post-credit crisis. From an interest rate perspective, as we step into 2010, both the variable and fixed rate mortgages are expected to remain stable, at least for the short term, for the first 3 to 6 months. Around the 6-month mark, we expect that the variable rate mortgage may go up. Presently it's at 2.25%. However, the Bank of Canada governor may adjust the overnight bank rate sometime in the middle of summer, which will cause the corresponding prime rate to increase. However, rest assured, if prime rate does go up, it should not go up significantly. The reason why I don't expect a significant increase in prime rate is because the prime rate is the lending rate that banks offer their best customers. The prime rate is also an indicator of how people's attitude is towards the economy. When prime rate goes up, people borrow less and the economy tends to slow down. When prime rate is low, the economy tends to speed up. We're trying to uncover ourselves from one of the worst recessions in Canadian history. So surely the Bank of Canada would not increase the overnight bank rate so much that prime rate would increase so much so that borrowing or economic activity will slow down, because we are certainly in a delicate phase of recovery. For those of you who have fixed rate mortgages and for whom prime rate doesn't mean a significant amount, rest assured that the fixed rate mortgages will also remain reasonably stable into the new year. We expect that come spring, early summer, and up to late autumn, the fixed rates may start adjusting upwards. Why? Because the fixed rate is not tied to the overnight bank rate as the variable rate is. The fixed rate is typically based upon what we call the 5-year Canada bond yield. Bond yields right now are at a very low rate, around 2% or so. However, we expect that the bond yields will be increasing as the economy improves sometime towards the spring, early summer, or late autumn. Rest assured, once again, don't expect the fixed rate mortgages to go up too high. This is not a situation where you should be panicking. It'll be a gradual and incremental increase, and it certainly will not be a significant jump from what you're probably experiencing now. For those of you looking to finance real estate into 2010, I believe that will be a great year for you. We are finally recovering from one of the worst credit crises in history, and Canada has survived well because of our strong banking network. It's a testimony to our strong banking network that our prime rate is as low as it is at 2.25, and currently our fixed rate as we step into 2010 can be seen as low as 3.90%. For those of you who are looking to do business in 2010, this is probably the best time in history to finance and take advantage of the low interest rates. Not to mention, during this winter season, real estate prices tend to be a bit lower than they are in the spring, summer, and autumn. Finally, as you look towards financing your real estate into the future, don't forget to use the services of an accredited mortgage professional, because they'll be able to arrange a pre-qualification for you and thereby hold rates for you for up to 120 days. Given that the 5-year fixed rate is as low as 3.90, certainly something to consider.